IMAX shares have surged on the back of Avatar 2's opening and China's reopening, which has helped lead IMAX to record-breaking Lunar New Year box office in China. For more, I should say, on the movie business as it navigates what has been a very difficult couple of years, let's bring in Rich Gelfond. He is the CEO of IMAX. Rich, I can't tell you the last time I went to the theaters. It was probably 10 years ago, but I came back to the theaters to watch Avatar 2 because there just are some films you have to go to the theaters for, irrespective of what's going on with streaming. And I guess that speaks to the Avatar effect that you talked about with shareholders.
Yeah, I think it's not, unfortunately, you know, it's been a long 10 years for you, but fortunately not a lot of people have followed your pattern of movie going. But you're right, I mean, there are certain movies that are made for the big screen, and a film like Avatar was really made for the biggest and best screen, which is IMAX. So we did over $250 million, just IMAX, in less than 1% of the screens in the world. We did 11%. And, you know, as a result, it's given some new momentum to our business. So the number of signings is up, the number of new theaters is up. You know, our outlook for this year is actually quite positive. So it's a good time to be in the IMAX business.
So some might argue, well, you only benefit while the film is in theaters, and then what happens? And I think you have some historical context of what happened with business when the first Avatar was released.
Yeah, and I think it's even should be better this time, because when the first one was released, you didn't know that there would be 4 more coming later. Now that the second one was released, you know there are 3 more. And so every 2 years, there's another Avatar. However, you know, it's not so, as a result, people want more IMAX theaters, they want to expand, they want to go into different countries. So you know, that's what creates all of this. But it's just not Avatar or bust. So for Top Gun, we did over $100 million. Top Gun Maverick, we've been doing much more local language films in different territories. So, for example, over Lunar New Year, which you referred to, in China, there's a film called Wandering Earth 2, where we did over $50 million. It became our biggest grossing movie in China ever. We do foreign films in India. There's a film called Pathan, where it became our second biggest Indian grossing film of all time. In Japan, anime is super popular over there, and we've done very well with it. And as a matter of fact, an anime film from Japan was released in Korea this weekend and did $1 million in Korea. So the world is becoming much more global, and we're one of the few companies from a entertainment point of view, and we're one of the few companies that's in a position to capitalize on that.
You know, a lot of people talk about that return to travel story post-pandemic, and you've got a great insight into the return to theaters post-pandemic, particularly in China. We mentioned you guys did very well during the Lunar New Year, but what is it like right now? How would you characterize that reopening of China and people's interest in heading to the theaters?
Well, very encouraging. So we had budgeted about $42 million for the Chinese New Year period, and we did over $60 million, so roughly 50% better than we thought. And in Avatar, we did 21% of the box office for the country on 1% of the screens, and then same thing for Ant-Man and the Wasp, which also did about 20% of the box office. So people seem to want to go back to the movies. And then beyond that, a lot of movies which weren't getting in are now getting in. So Black Panther got in, Ant-Man got in. This weekend, or maybe it's next weekend, Shazam is getting in, Dungeons and Dragons is getting in. And I think you'll see a return to several years ago where a lot of movies got in. So a combination of people wanting to go and the movies opening there, I think bodes well.
You know, you highlight those movies getting in China, actually getting the approval to be shown there as tensions flare up between the United States and China. Do you think about that as a risk to your business there, that China could retaliate in any kind of way? One of them could be, you know, shutting out the film industry.
Yeah, I mean, of course, anything is possible. But the film industry is really important to China because most of the IMAX theaters, almost all of them, are in big shopping malls. And you probably read the report today about a more conservative outlook for the economy. But the economy is the top priority right now. That's what the Chinese are focused on. And if you want those consumers to go to shopping malls and you want them spending money, you want theaters open and you want good movies there that are going to attract a lot of people. So I think anything's possible, but in my mind, I think the likelihood is remote that they would clamp down on movies.
Rich, thank you so much for that perspective and those insights. We appreciate it. I'll try not to make it another 10 years before I go to the theater again.
And tell your friends not to make it 10 years either, okay?
I will. We're all going to get off the couch. Thank you so much to Rich Galfond, the CEO of IMAX.
We have a treat for you. Pierre Lassonde joins us on set. He's chairman and CEO of Farlight Investments, but well known as a co-founder of Franco-Nevada, one of the fathers of precious metal streaming. Great to have you here.
Always a pleasure, Andrew. Thank you for having me.
A lot of buzz about these critical minerals, governments falling over themselves to subsidize producers, miners in some cases. What do you think?
Well, you know what? The PDAC, which is ongoing right now, is all abuzz with critical metals. And for me, the most important take of this is that governments and politicians, for the first time in living memory, are finally listening to the mining industry because they've recognized that they need us to be able to go to a greener world. So that's the one big takeaway from, you know, the number of governments that are represented at the PDAC, number one. Number two, the whole critical metal is interesting. Some are more critical than others, okay? But to me, the least critical would be lithium.
Lithium?
Oh, yeah, because lithium, in case you don't know, is the second most common element on the planet. Okay, so if anything, what's going to happen, and you can see it, government are giving away money either left, right, and center to develop lithium mines, we're going to end up with a surplus. And if you don't have a contract, you don't have anything.
An offtake. If you're a miner, if you don't have an offtake deal? Yeah,
because then you have to sell in the market, and it's going to be a price taker. And we're going to end up with, you know, essentially, the lithium price is already down 35% from the top. It's going to go down a lot more, okay? The most critical of all element is copper. Because copper carries electricity, and electricity is life. Electricity is what gives you transportation, it's what gives you communication, it's what gives you essentially the standard of living that we have today. It is the most critical metal. And it's also the one that is the most difficult to find, and that's why it's like $4 a pound.
Yeah, and it's interesting. Also, aluminum. Aluminum is big for electric transmission. I hadn't realized that it was so common. Yeah.
All the, you know, very high voltage wire has to be aluminum. So yes, if we end up with like, you know, hundreds of thousands of kilometers of new transmission, you need aluminum. Absolutely.
Cobalt as well has come down. I mean, that's a weird market. It's dominated by horrible mining practices. Well, a lot of it anyway in the Democratic Republic of Congo. But apparently a glut has developed in cobalt.
Well, yeah, because I think that what's happened and will always happen is essentially the battery makers and the automobile industry, if the prices gets too high, they always find a way to substitute whatever metals that the price goes crazy. So if the price of cobalt goes up, you know, to like $50 a pound, what do you think happened? They find substitution that works perfectly well.
Yeah, that's right. Now, just on lithium, I don't know if it's as common as you said, but certainly it's widely distributed in rocks, soils, seawater, on the surface, in the ground.
Oh, yeah. I mean, you're not going to run out of lithium, okay? Like, that's for sure. The problem, of course, is the ramping up of all of these mines.
Yeah.
And if they're all approved, we are going to end up with a massive surplus. But I will add one more thing, is that the battery technology that we have today is, I don't think, good enough to carry us into the green world. The batteries are not long enough. They don't have enough power in them. And just like the lead-acid battery was fully developed by 1970, the lithium, whatever, will be fully developed in the next 5 years. There will be new technology coming along. Will it be based on lithium? No one knows.
Maybe the fuel cell, the hydrogen, will build a market share. It's still pretty small.
It's still pretty small, but there will be other batteries coming up. But we don't know the technology. It could be right around the corner. We don't know. So, but copper, there's no choice. There's nothing around the corner that will save us from copper. So for me, if I want to invest in critical metal, the place to be is still copper.
You probably saw Robert Friedland at PDAC this week warned that preventing the Chinese from investing in mining companies, as Canada has tentatively started to do, telling them to sell out of 3 lithium juniors, will be a problem for the mining industry because it needs Chinese capital.
Well, no, I don't think the mining industry in Canada needs Chinese capital. We have a capital market that functions really well. And
he may have been talking globally, but carry on, Pierre. Yeah.
Yeah, he talks his portfolio because, who is he in bed with in the Congo is the Chinese.
Mining. Yeah,
exactly. Okay, so, when you're long, you love, right? Okay. We understand this game, no problem.
And then, of course, the industry minister hit back. Mr. Champagne said, well, I'm a hawk on this stuff. I'm concerned about national security. He blocked, the government blocked the purchase of TMAC resources, as you know, up in Nunavut. Should we be wary about Chinese companies which are controlled by the government de facto?
What we should be worried about is the fact that back 20 years ago, we let our biggest mining companies go for a song, the Noranda of the world, the Falconbridge, the Inco, and today all of these jobs, head office, research, R&D, Inco had a battery technology. They were working on battery technology back in the 70s. All of that is gone because our government let them go. So now it's a retrograde action. Okay, now it says even the tiny company, we're not going to let them go. Well, the reality is that they missed the boat 20 years ago. But at least we're seeing some positive action here in Ontario by the government about access to the land, about process of and that is excellent news. And you look at Saskatchewan; it's #1 jurisdiction in the world. Yeah. In terms of mining investment. So we got a lot of good things going in Canada. A lot of good things.
Of course, tech could go now. People are saying that they're going to, in a while, get rid of the dual voting shares.
It could, and I sure hope that our government have more sense than that.
Yeah. It seems the Aussies, the Australians, are more nationalistic about this stuff.
Definitely. They would not let any of their big companies go. And they're right. They're absolutely right, because when it comes, the great thing about Canada is we have the 2nd largest land mass in the world. Well, where do you find mines? On land, okay? So we have a strategic worldwide advantage, and we have the capital. But if you let all the big mining companies go to Brazil and go to London and, we then get, we miss that talent that is desperately needed.
Yeah, as you say, and companies are going to put the research often in their home country. Yeah, so, it's an intangible thing, but if you lose those head offices,
Absolutely. So I hope that, Teck stays Canadian for sure and becomes a champion of Canada. Maybe do a couple of acquisition and become the next Glencore or, the next Rio.
Pierre, we better jump. Thanks. It's always great having you join us. Thanks very much.
Well, today is International Women's Day, and here at BNN Bloomberg, we're focusing on the advancement of women in the ranks of business leadership. A new report from Grant Thornton shows that Canada ranks above the global median, with 39% of senior management positions held by women. That's up 17% since 2004. And a study by Osler shows that in 2022, a significant majority of executive teams in Canada included at least one woman. For more on this, we're joined by Jennifer Reynolds. She's Chief Executive Officer of Women Corporate Directors. Jennifer, thank you for joining us on an important conversation on an important day. We're just going to bring up those graphs again, and I'll describe them briefly to viewers. First, the bar graph, which shows the Canadian picture. This comes from Osler. The white portion of those graphs, the graphs themselves in their entirety show the proportion of females on corporate boards in Canada. The blue segment of the graph shows the representation in TSX 60 companies. Those are the biggest publicly traded companies in Canada. You can see the trend is upward across all segments from 2018 to 2022. Here's another graph. This is a line graph. This comes from Grant Thornton. This is the global percentage of females in senior leadership. And you can see the most recent figure is 32.4%. And we are told that Canada is significantly above that at 39%. So with that data in the background, Jennifer, is Canada punching above its weight? Is it doing what it needs to do in bringing more females into board and management positions?
Yeah, well, you've got a lot of different data points there. So it depends on how you slice and dice the data. I think the Grant Thornton report was more about mid-sized companies, so a much broader group of companies. And we know that Canada is made up of small and medium-sized companies, essentially. So it appears from that data that our medium-sized companies are actually outperforming relative to others globally. And you could argue, if you look at the data from Osler's and from the OSC, that they're outperforming our bigger companies because, if you think about the executive teams there, they're only at about 19%. Our boards are about 26% now. So I think if you think about the larger publicly traded company, if you compared that globally, you would see Canada really middle of the pack there. You'd see UK, Australia, European countries, Scandinavian countries ahead of us on boards and executive suites. And then, in terms of those smaller companies, though, it appears we're outperforming. And that's an interesting dynamic. So what does that say about where women are working in Canada?
What does Canada need to do more of to increase the numbers, and who should be doing it? Companies, regulators, governments?
I think we all need to be very focused on this. I think if you think about, only generally about, one or two women in the executive suite in larger companies, and yet we're over half of university grads for decades, we're not really using the talent pool effectively if we aren't driving all of those very educated females into leadership roles in the economy. So I think that, from a policy regulatory perspective, we do need to be focused on that. I mean, that's why we have things like the diversity disclosure that we have in Canada for public companies, so that we're making sure we're focused on this. I think companies need to be very focused on it as well. We know that COVID has had an impact on the pipeline of women for leadership roles. And so at a time when we really couldn't afford to have issues with our pipeline of women for leadership. So I think we really need to double down on all of our efforts here to make sure that we are really managing our talent pool effectively and bringing everyone along.
How significant is it that, at least anecdotally, people who follow the business news see females in CEO positions certainly more often than they did 5 or 10 years ago? Mary Barra, for instance, is the chief executive officer of one of the most important corporations in the U.S., General Motors.
I think it's very important. Unfortunately, that stat's been glacial. I think we've seen positive movement on the number of women on boards. There's no doubt about that. I'd love to see more of that. But where we haven't seen progress is in the CEO role. Actually, it's really been about 4 or 5%. And it moves up and down. And I think it's important to see like a Mary Barra because, huge company, very influential. It sends a strong message that women can lead the largest companies globally. And that's important. And we need to see more of that. But I would love to see, if you look at the major corporations in Canada, how many of them have female CEOs, and it's not very many. And I think that is an important problem that we need to think about, because how do we fix that? You need to get more women in the executive suite, number one. We know we've got about 19% now, but you also need to get them in roles which lead to the CEO. And those roles are profit and loss roles, heading big portions of the business. Those people get promoted to CEO, whereas people who are chief legal officer or chief human resource officer, not to denigrate those roles, but they generally don't result in getting to the CEO chair. So we really need to think about how we are managing, as I said earlier, that pipeline for leadership and getting those women the experience they need so they're ready to take on a role, the CEO role.
Hybrid work and childcare duties. Everybody recognizes that women tend to have stronger or heavier family and childcare burdens than perhaps men do. Hybrid work, one would think, is helping female employees stay at home more often and take care of their children and work at the same time. Is that material, however, to the very senior roles that we're talking about here?
That's an interesting question. I think that in the most senior roles, it's certainly helped, because I think what's gone away is the stigma of working from home, that if you're working from home, you couldn't possibly be productive. I think we've certainly proven that theory wrong. And for a long time, that was the narrative prior to the pandemic. But I will say that I think it's a bit of a double-edged sword, because I do think, I am a believer, and this may be unpopular with some viewers or some people, you do need to spend some time in the office. I'm a believer in being together and bringing groups together in person, and that can create a team dynamic that is different than what you might get on Zoom. So I think we need a balance. I think it's good that you don't have to be in the office 5 days a week for 12 hours a day. You can be working at home some days. But I do think there's a balance there, because if you're going to get promoted into leadership roles, you generally need to create very strong relationships with the people around you. You need to garner sponsorship from senior leaders, people who will pound the table for you to get promoted. And I just believe it's a lot harder to develop those types of relationships and that sponsorship over a screen.
Finally, why don't we finish with you just explaining what your organization, Women Corporate Directors, does in this regard?
Yeah, so we're the largest network globally of women corporate directors, 2,500 around the world, about half of those in the US, and then the rest spread throughout 6 continents. And really, we're advocating for more women, clearly, in leadership roles, on boards, in the executive suite. And we provide a network of a very influential group of women who can help other women get into those positions, and who are influencing in their own corporate boardrooms what's happening, and bringing a new dimension, I believe, to leadership. Because I think we've seen, over this period, leadership has become very complex. The issues that we're seeing are very complex, and I think they require even more today the diversity of thought that we need at the table. And so we're really advocating for that as an organization globally.
Jennifer Reynolds, thank you so much for this conversation. She's CEO of Women Corporate Directors on International Women's Day.
Walmart has been trying to chip away at Amazon's dominance in the online marketplace, and is now showing some success at attracting wealthier shoppers online. For more, we are joined by Bloomberg's Spencer Soper. So, Spencer, this comes down to the subscription offerings between these two. What are the key differences?
Yeah, so we're looking at Amazon Prime, which is very well known in the U.S. It costs $139 a year. Most people associate it with the free shipping, and then there's also video streaming and some other benefits layered on top of that. Walmart a couple years ago unveiled Walmart Plus, which is $100 a year, so about $40 less, and a lot of the same benefits. But a big differentiator for Walmart is quick delivery of groceries from their stores. They've got physical stores that sell fresh groceries within about a 10-mile drive of 90% of the U.S. population. So that's a big spot where they have a real competitive advantage over Amazon.
Yeah, and when it comes to the types of customers that they're attracting with this, Walmart, this is a more affluent customer that's joining on to this subscription service?
Yeah, and if you think, most people would usually associate the Walmart shopper as being, low income, middle income, and Amazon shopper being a little more affluent, even though there is a lot of crossover between the two customer bases. But we had some data that showing that Walmart's actually having success adding these higher income households, $150,000 in annual income plus a year. So these are folks that just have more discretionary income. And we're just seeing the effects of people trading down. People feeling the pinch of inflation, even those with a little more money are feel the pinch of inflation, and so they'll trade down and look for deals. And Walmart brand just stands out as a place to go for deals.
What about the stores themselves, though? Do they still, play a big role when it comes to Walmart?
Yeah, definitely. The stores are still where they get most of their sales and play a big role. And the interesting thing here is that Walmart, as it develops its online presence, there's a lot of interest among brands of the interplay between, how a shopper acts online versus in store, and how those things interact. Because most shoppers do both. They shop online and shop in store, and that's where Walmart is going to have a bit of an advantage in terms of the visibility of its Walmart Plus subscribers. Like, hey, what are they buying online or seeing online? Are they buying it in the store? And that's going to be very valuable to brands, that kind of intelligence. And again, something that for the moment, Amazon can't really match.
Yeah, what about Amazon? If Walmart is becoming a stronger player in this space, what do you think Amazon might need to be doing, or it might be thinking about when it's looking at maybe a growing threat from Walmart?
Yeah, I think that they're just going to have to be mindful of price, right? Like Prime was pretty much in a league of its own. No one could really match it. The Prime membership, Amazon every few years raises the price $20. Are they going to have to be a little more cautious about the next price hike for Amazon Prime? And also, they've even said this. They've got to find a way to get to appeal to the mass market with some sort of grocery solution and some sort of physical grocery solution, which they've been working on. They purchased Whole Foods several years ago. That's just been pretty flat since they bought it.
Right.
They're developing this grocery concept, Amazon Fresh. So they still got to figure out how to match that physical presence.
I guess with Amazon Prime, you're also getting their video streaming service as well, or whatever you want to call it.
Yeah, so they, as part of your bundle, you pay, you get Prime Video, which is a pretty abundant streaming option. Walmart Plus has bundled in Paramount Plus, which is another video streaming option.
Oh, okay.
So they do have a video streaming option there for you in Walmart Plus that's included. And then Amazon has Amazon Music. Walmart doesn't really have a music option. They give you like a free trial of Spotify, but you'll have to pay extra after that. So there are these kind of like smaller tiers of things. But I think the predominant reason people will subscribe to either of these things is just to lock in kind of the all you can buy online with free delivery buffet.
Yeah, all you can order. Spencer, thanks so much for joining us today. We appreciate it.
All right, let's get right to it and continue our opening bell coverage on this Thursday morning. We mentioned kind of a mixed start to the trading day, a little strength after the jobless claims data in the United States. But the big story at this point is going to be the jobs reports on both sides of the border tomorrow. And we've already talked this morning about what feels like two different paths for the Canadian and U.S. central banks. More hawkish rhetoric this week from the Fed, which did weigh on stocks. But the Bank of Canada is saying, look, we got to get ready for what could lie ahead, given all this rate tightening we've seen recently. David Pepal is a portfolio manager with Aventine Investment Counsel. He joins us now to talk a little bit more about how you position in an environment like this.
Absolutely.
What's the strategy?
Well, first off, I'll say that I think we would have been shocked at Aventine if the Bank of Canada didn't hold rates where they are. In Canada, we get inundated with U.S. media, but we are in a different inflation regime than they are. If you go back to late last year and you look at core CPI in Canada, it's been relatively flat. And if you annualize it, you're running at about 2%. That's very different than the U.S. If you look at core inflation over the last 3 months in the U.S., it's about 2.9%. In Canada, that's 0.3%. So when you add that in to our dependence on the housing market, the fact that growth is slowing and that wages seem to be moderating, I think it's the right time for the Bank of Canada to pause. And I'll say, I don't think it can be overstated, our dependence on housing. Between February of 2021 and March of 2022, I think we originated about $260 billion worth of mortgages in Canada at about 1.5%. So the dependence on housing, if those get reset higher, there's a recession is certainly here.
Well, it's interesting. We were talking with David Rosenberg earlier in the program, and he was comparing it to the uncomfortable situation the U.S. found itself in back in 07, 08, which is a pretty scary thought. But speaking of the U.S. as well, he's making the argument, why is everybody so fussed or specifically targeting the Fed at truly getting inflation back to a 2% target if we've had some historical evidence that suggests that the economy, even the markets, can do pretty well when your inflation is running above a level like that?
Yeah, no, I think I'd agree with that. And I would say that, we're in the camp that inflation can come down in the U.S. by year end. The Cleveland Fed comes out with a pretty accurate forecast of rents. And the Federal Reserve is focused on core CPI. And the most important aspect of core is the shelter CPI. And so they're predicting that by year end, the shelter CPI component will be at 4.66%. And if it is at 4.66%, and you plug that into the January core CPI number that we got for the US, and you annualize that essentially means that core CPI by year end could be at 3.2% just based on housing alone. And that presents a very different picture for the Fed. I mean, that's below their target at the current moment.
Fancy calculator to make that happen.
Yeah, well,
but I guess the other question, though, is where is the economy at that point, given the rate hikes that we have seen, not to mention this commitment in the U.S. to more rate hikes for the foreseeable future? Just to go back to Rosenberg, I mean, he's throwing out recession as a second quarter possible reality in 2023.
Yeah.
So I guess I wonder, recession realities, what does that mean for stocks?
Well, we came into the year, I'd say, not so bullish, not so bearish.
Okay.
And what that really means is we're not advocating full risk on. You look at the MOVE index or interest rate volatility, that was going to tell you that you were going to have some ups and downs this year. But the basis of that was that a recession was more priced in and more manageable than the inflation shocks that we saw in 2022. But we still think that's the case. So the economy, I think, if you asked me at the beginning of the year, what would make me more bullish? I probably would have told you two things. One, the market being more realistic about Federal Reserve rate hikes, and two, inflation coming down. Now, if you look at the Euro-Dollars futures curve, which is essentially interest rate futures, at the beginning of the year, it was predicting 50 basis points of cuts by the Fed. It's now predicting 60 basis points of hikes. That might, that's certainly more realistic and might even be too bearish. So I think, and then on the inflation front, it goes back to what I was saying. I think that, shelter CPI is being ignored, but that could really come down, and that would impact core CPI a lot.
So I guess at the end of the day, how are you thinking about, where you want to put your money to work in equities? Your comments this morning, a little different than what sort of the standard comments I hear on this show, which is, well, you get, decent returns right now by putting money to work in fixed income. Why not wait it out there?
Yeah, well, I totally agree. I think the yields on short-term U.S. government bonds are impossible to ignore. You're getting a one-year T-bill yield of 5%. You'd only have to go back a couple of years in order to get that, you'd have to lever up high-yield corporate bonds. So that's incredibly attractive. And something really interesting happened in the bond market this week. After Powell's testimony, the 2-year yield spiked dramatically, but the 10-year yield stayed relatively well anchored. That tells me that the market's telling the Fed that much more of this and you're going to break something. It also tells investors that duration might not be so scary anymore, that bonds are now the longer term bonds are moving from just being a yield provider back to being a diversifier. That's a big change from last year.
But that would still play into the idea of being in the bond market. And I know you're looking at the equity market.
Well, we look at both, right?
Yeah.
In our client accounts, we run 2 internal funds at Aventine that are equity focused, but we have separately managed accounts for clients in which we're taking advantage of the yield situation. In the equity market, I think, it's time to look at some sort of technology stocks. For the past year, everybody's been bearish because they're saying that as interest rates go up, these long-dated cash flow companies, the present value comes down. But I think what doesn't get talked about enough is that relationship is nonlinear. So as the interest rates continue to increase, the incremental impact to present value goes down.
And in technology, I know one name you mentioned to our producer was Nintendo. Which I guess maybe just because of how it trades and where it trades, we don't talk as much about it as, say, an Apple or an Alphabet or whatever.
Right. And it's interesting. Nintendo's a very new one for us, and we think it's interesting because it's misunderstood. Everybody knows of it, right, as a gaming platform and an IP holder of Mario, Pokemon, and Zelda. But what we think of it as a up-and-coming entertainment company and software provider. The stock's been hit dramatically lately because for the first time ever, its major hardware platform, the Switch, had a decrease in sales. And, the COVID gaming hangover. But we're not that concerned about that. In the meantime, they're producing a movie which is coming out, the Mario Brothers movie, in April. They have a theme park. They're licensing their merchandise. And their next generation Switch will provide a lot more third-party games. And what they're doing now is their digital sales are 50% of their software sales. So they've moved their margin from 7% in 2017 to 35% today without a big impact on their multiple. So we think it's really attractive. They have no debt. They traded a PE of 12 net of cash, and they pay a good yield. And I'll say one other thing. We think the government intervention in the M&A market in the gaming industry has increased the value of their assets. Microsoft's trying to buy Activision, and a lot of competition bureaus are having an issue with that. Because so now if you're a platform provider, you can't just go out and buy IP. Nintendo has both. The value of those assets have gone up.
David, nice to have you back with us. Appreciate the time.
Thank you so much. Appreciate it.